So, hello everyone. Welcome to our September webinar. Today is our back to school basics, and we're going to be taking our financial education back to the basics. So, I'm your moderator today, Anastasia. I am your marketing specialist here at Malecki Financial Group, and we have two amazing guests here today to help us out and give us professional advice for this one. So, let's meet the team.
Hi, everyone. I'm Stan Malecki. I'm actually the owner and president here of Malecki Financial Group, and I specialize in working with outdoor loving business owners and kind of helping them their next stage after exiting their businesses.
And I'm Eric Stiles, and I'm a certified financial planning professional here at Malecki Financial Group, and I help you retire early.
Hey, thanks, guys. So quickly before we get started, we just want to remind you what we're actually going over here today. So we're reviewing how to build a budget that works for you, the basics of an emergency fund, different strategies for paying down debt, and just some key financial terms that you might encounter along the way.
All right, so let's get started here on some of the key vocab today, kind of on the basic side to start it off. So income. Income is money received, especially on a regular basis coming in. It could be from work or through investments or other sources. And then what we're going to do is look at some expenses. The expenses are kind of the opposite of that. That's money going out to pay for bills and different things. And of course, most of us probably know what our expenses are. Now, the other thing is the emergency funds. This is critical. We want to talk about that. We're going to dive into it a little bit. This is really liquid investments, or I'm sorry, liquid expenses saved specifically to help in the case of an emergency. And then credit score is a number assigned to a person that indicates their ability to repay back a loan or credit or debt. So, and then let's take a look now at, this is kind of on the more advanced side. We're going to look at a couple different vocabulary things here. So APR stands for annual percentage rate. It's the annual cost of borrowing money, including interest and fees. So some examples could be a credit card, like we're seeing here on the screen, at a 20% interest rate, or APR. So, you know, what that really means to you. You have to pay down that extra, that added interest in debt, which definitely can strain us. The higher the interest rate, or that APR, is more straining on us when we pay back debt. Amortization is paying off debt in regular installments over time. And an example of that, is kind of how mortgages work and how we can pay off mortgages over time. They usually are amortized over different periods of time. Liquidity is how easily we can access money, which is also critical. And when you're talking about easy cash, so we want cash is going to be liquid investments like savings accounts, money market accounts, and things of that nature, cash, versus investments that are long-term, that are really earmarked for retirement.
All right, so we've gone over some of the basic and a little bit more advanced vocab. I think we're ready to discuss some strategies. And before, Eric, I ask you to tell us about budgeting, I just want to remind you there's a Q&A box if you have any questions while we're going throughout this so that we can help you out. Eric?
All right, perfect. So budgeting is the process of following your cash flow, your money coming in, your money coming out, and ideally having a plan for how you like each month and the year to go. You know, the key elements is your income. That's all your money coming in. That could be from your W-2. If you have a side hustle and you get 1099, that could include that as well. Also, if you have rental property, any rental income that comes in, that's considered as income as well. Then you have your fixed expenses. These are expenses that generally are not going to change from month to month. Some examples are rent, mortgage, car payments. Of course, rent can go up as you sign a new lease, and your mortgage payments can go up as your taxes and insurance can go up. But generally, from month to month, it's generally pretty consistently the same, and that's very easy to track, very easy to set up. And unfortunately, the more difficult side is variable expenses. These are costs that can fluctuate depending on your specific situation, the month, time of the year, and some of the examples are groceries, entertainment, sporting events, back to school shopping, These are expenses that are not the same from month to month and can vary. And then lastly, an element of your budget is the amount you're putting away for your savings and for building up your emergency fund, which is a very key element as well.
All right, so that pretty much covers it. But what about when you're creating one? How can you do that if you're just kind of starting out now?
So first things first, let's figure out how much money is coming in. List all of your different income sources and the corresponding amounts that are going to be coming in. Second, I would start by listing, just from a category perspective, all the different types of fixed and variable expenses, and then write the corresponding amounts next to them. Now, like I said, for fixed, you should be able to get that number pretty quickly, and it's something that doesn't really change. That's your minimum car payment, your mortgage, your rent. It's not really going to change. But for your variable expenses, like your utilities, your groceries, that's something that changes, over time. And in the beginning, I'd say, try to put an estimate for how much you think it's going to be each month, but it's going to be a little bit of trial and error as you first start to build a budget, and you're going to start to see how much like the average is over time, and you're going to be able to figure out where you can cut back or what you're kind of shooting for. And then second, third actually, set your financial goals. Are you saving for a vacation? Are you trying to pay off your debt early in a certain amount of years? Are you trying to retire at a certain year? All those different goals require a certain amount of cash flow to go to those savings. And so when you kind of set your goals, you're gonna know at the end of each month, I want an X amount of positive cash flow that I can use for funding and saving for those goals. Then lastly, once it's all set up, you just got to start tracking it. Track your spending. There was a lot of good apps that you can use. Some of them, will have you can log into all your credit cards, your bank statements, and it'll start to set a budget like automatically through their systems. And you'll have to do some manual work as well, or just create your own manual budget. It's a lot more work, but it's hands-on, and you can follow it as well. And an example of kind of a strategy of how you want to set up your budget is known as the 50-30-20 rule. 50% of your budget should be going to your needs. That's your rent, that's your minimum payments and all your debts, that's your utilities. And then 30% should go to your wants. That's your fun stuff. That is going to a Jets game, and that is going golfing or taking the kids on a vacation. And so that's where your wants come in. And then 20% should be going to saving for retirement, saving for your pre-retirement needs, for future college expenses. And the debt payment portion, this 20%, is the additional amount that you're putting to try to pay down your debts quicker. The minimum payments on your debts are included in the 50% needs bucket. So this is kind of a general guideline of what your budget should look like. But what I will say, it's not perfect for everyone. Some people have unique situations, and maybe there might be someone that their needs are only 40% of their budget, and you have an extra 10% that you can move different areas. Or there may be someone on the opposite end that, for every reason, hasn't saved enough for retirement, and they're getting close to that date, and maybe they need to be putting more than 20% towards that goal. So everyone's unique. So this is a good starting point, but I recommend you work with your financial professional to build a more specific plan for you.
Thanks, Eric. So something I noticed you mentioned a couple of times, but could one of you explain a little bit more about emergency funds?
Yeah, I'll take that one. So emergency funds, critical. So it's a reserve of money set aside for unexpected financial challenges. And some of the examples of that could be a job loss. It could be medical emergencies come up. It could be the transmission in the car or the hot water heater in the home just broke and things of that nature. So you want this set aside separate from savings, by the way. You want to have a certain dollar amount. Let's kind of talk about that, or a certain amount should be set aside. So again, separate. Emergency is specifically for those needs should something unforeseen come up. So let's talk about how much to save. You want to kind of calculate, like Eric was just talking about on budgeting. You also want to kind of calculate about, what the minimum monthly expenses are from your budget. And you need to put away, we recommend on average 3 to 6 months of living expenses. So if you have 2 incomes coming into the household, maybe you only need three months of savings, and everybody's different. So that might not be specific for all. Or maybe one income, maybe there's only one income earner, mom or dad is home with, and you have children. That one we recommend definitely more money set aside. 6 months is probably more likely for that. And again, this is just, for an emergency type setup. And you want to make sure to keep this money liquid. It's got to be easily to access, and you want to remember, if you do use it, you need to refill it immediately after using it, and keep that that emergency means at that 3 to 6 month kind of level.
Yeah, and one thing to kind of add in is once you have your budget set up and you've been tracking it for a number of months, it then becomes much easier to create that estimate. If worst case scenario, we lose our jobs and there's no more income coming into the household. If you've been tracking your budget over the months and years, you know, okay, this is the minimum I need to stay afloat, and then you can then correlate that to determining your emergency fund.
Perfect.
Thank you guys. So something that's been mentioned now a couple of times is being prepared for in case of an emergency. But what if you aren't? Or what if you buy a home, a car, pursue higher education? That could put you in debt, right? So how do you handle that?
Yeah, so there's definitely a few routes that you can go. For a lot of people, they have debts all over the place. They have, student loans, they have car loans, they credit, unfortunately, credit card debt, mortgage, and sometimes it's kind of all over the place, and you don't really know where to start. Well, these are kind of three example routes of where you can go. The first being as a debt snowball. So kind of how it works is you write down, you list all of your debts from the smallest balances left to the largest from top down, and then you start paying the minimum payments on all of them, but you send as much money, extra money, as you can to the smallest balance. And then what you do is you keep sending that extra money to that one until it's paid off. And then from there, you're no longer paying that extra amount to the smallest balance. You're not paying the minimum on that smallest balance either. You just take that, pick it up, bring it to the next smallest balance, and you keep going down the line. The reason why they call it a snowball is because as you start to pick up speed of paying off these debts, the amount that you're putting away to the ones further down the list starts to get bigger and bigger and bigger, and it should help you, pay it off in a suitable manner. The other option is similar, just you're following a little bit of a different factor, is the debt avalanche. So instead of looking at the balances, you're looking at the interest rates. Same thing, list down all of your debts from highest interest rate to lowest interest rate, pay the minimum on all of your debts, but then send all of the extra money you can to the highest interest rate item. And then same thing, keep on sending extra and extra until it's paid off. And then you pick up that amount you were sending to that highest interest rate item, and you bring it down to the second highest, and you keep going down that list. And then the final option is something called debt consolidation, where there's a lot of debt consolidation companies out there where you can, if you have a lot of different various sources and they're at higher interest rates, you could consider looking into consolidating it all into one debt. So instead of sending payments across all the different sources, you're sending it to one place under one interest rate. And the idea of it is to hope to, when doing that, it's going to be putting it at a lower interest rate than what your average of all your other debts currently would be. So those are some three methods. They all can work. It just all depends on your specific situation. And then, as far as, okay, let's say you don't have any debts now, but you're considering buying a home or getting a car or buying a second home, what can you afford? And that's where, some of these pro tips are going to come in. But first and foremost, I know we talk about a lot, you really have to make sure you have an emergency fund to cover all the expected expenses. If you lose your income, you want to still be able to meet all the minimum payments and all your debts. So if you're considering buying a house or buying a car, you need to for future anticipate that, is my emergency fund ready to handle this additional debt if I were to get it. And then beyond that point, there's two really key rules, and they do work together to follow, and that's the 36% rule. So if you take your monthly gross income, 36% of that monthly gross income should be the maximum amount you put to your minimum debt payments. So that's your mortgage, that's your car loan, student loans, credit card debt. The minimum payments on that should not exceed 36%. And then the 28% rule works in conjunction with 36%. So out of the 36%, 28% should be the majority that goes to your monthly PITI payments. PITI is your principal, interest, taxes, insurance. That's everything that goes into owning a home and your mortgage. That total payment should not exceed 28% of your gross income. And the reason why there are these rules is because once you start to exceed and go above these limits, you're going to start to really stretch out your budget and really stretch out your cash flow and put yourself in situations that you may not be able to cover your monthly expenses. And then now you're starting to look at potentially, carrying over on a credit card, which can really spiral into something you want to avoid.
So far, we've covered budgeting and debt and a lot of money going out in that regard, but let's talk about potentially making some more with investing.
So here we go. So a little bit on the investing side. So investing is the act of allocating resource with expectation of generating income or profit. So some of the main reasons to begin investing is to build wealth over time. Remember, it isn't instant. This is the long game we're kind of looking at here. So you want to build wealth over time. You want to structure it so you're outpacing inflation and keep up above, because cost of living keeps going up, as we all know. So you need to have investment income that's hopefully generating higher than what inflation is, so that you can keep pace with that and outpace it is really the goal there. And eventually you want to reach your financial goals, whether it's education, whether it's retirement, whether it's a second home, or whatever it might be, whatever that goal is. We're going to talk more about it, more being diversified in some of the ways to reach those goals successfully over time. So let's talk a little bit about more on the, kind of equity ownership here. What are we talking about? A couple different ways to invest. So equity ownership in an asset, usually stocks, is a good example of owning companies, owning great companies over time. No guarantee, but some of them could be very, very good for equity ownership, again, over time, kind of looking at that long-term view. Dividends is a portion of the company's profits that pay back to shareholders. So not all companies are the same. Some companies focus on dividends and pay dividends to the shareholders. Other ones are growth oriented and don't pay dividends. So there's different ones out there to be aware of. Asset allocation is a term you might have heard. Basically, that's how an investor divides their investments among many different asset categories. They call that asset allocation, and it helps diversify you over the course of time, because some assets go up when others are going down. So it helps smooth out the ride for that long-term investor. Liquidity, here's another one. We talked about it earlier. The ability to quickly convert investments into cash. So that's also key. You don't want to have something illiquid if you need access to those funds or that money. So very important. And diversification is a little deeper dive from asset allocation. What we're talking about here is spreading your investments across different assets within those asset classes. So specifically, we're talking about different types of stocks. So it could be large company stocks. It could be mid-sized company, smaller companies. Some might be dividend paying, like I mentioned. Others might be, growth oriented, international companies. So you kind of get the point. Broad diversification, use a financial professional. There's so many different ways. You want to make sure you're invested correctly and you have the appropriate diversification for the risk. It helps reduce risk through diversification.
Okay, so I'll be the first person to say that can be a little bit confusing. So can you explain a little bit more about the different types of investments you just mentioned?
Sure, I can touch on this. So we have 4 listed here that I'll kind of go over. So stocks, Stan kind of mentioned with equities, but this is where when you own a share of stock, you own a share of that publicly traded company. You're technically a partial owner. And with stocks, it's high risk, but also, high reward, but also high risk. Over time, it has shown to appreciate, but it is a risky investment, and you got to take it seriously when you're considering investing in it, because the company that you invest in, it could do well, it could go down, and so just be very careful with stocks. Bonds are essentially, you are loaning your money, whether it be to a private company or to the government, and in exchange, they're going to pay you a fixed interest on the investment if you hold it to maturity. So bonds are traditionally over time have been a less risky investment than stocks, and they do usually work well together when you pair stocks and bonds within the same portfolio. Mutual funds and exchange traded funds are a collection of stocks and bonds or other assets bundled to one investment. So instead of picking an individual stock, individual company to invest in, or an individual bond to loan your money to in return for an interest rate, you could just pick one of these vehicles that within it could hold up to thousands of different company stocks, different bonds, and it's more of a simpler setup instead of investing in just one company. And real estate, it's pretty straightforward. If you own a property and you charge rent for people to use your property, and and that's a way to generate income and to increase your cash flow, but also you can then participate in if there is growth, in the growth of the real estate market and just the general appreciation of the property price. So those are 4 different investment types to consider. And a lot of times when you build a healthy asset allocation, you will see a number of these all in play within the same asset allocation. All right. All right. So as far as for, when you're investing, what's really important is making sure that you compound your interest, which is interest on both, not just your initial investment, but on the previous interest that you might have earned in previous months or previous years, over time. It's really important to start early in your investment career, especially for retirement. Generally, the earlier you start, the more suitable path you'll be on to gain confidence in your future. And we're going to go through an example on the next slide that goes through 4 different investors and what would have happened if you started investing $200 a month at various different times with different situations. And we're going to be able to demonstrate what these different paths and the power of compounding interest looks like. All right, so let's show the first investor. So the first investor we'll call the consistent investor. Started age 25, invested $200 a month through age 65, and was invested at a level in the stock market and the bond market that they were able to gain a hypothetical 7% annual return, which this is all hypothetical. That 7% is going to be the number we use. Nothing is guaranteed. In that example, the consistent investor at age 65 would end with $512,700 in their investment. So a great growth over that time frame. And let's look at the next one. The next one we have is the early investor. Let's say they did start early, which is great. Started at 25, but they weren't consistent and they stopped at 35. They only put away $200 a month, just like the other, and they were investing the same way to get a 7% return. You see that the drastic drop off here, you're looking at, only 270,100, in this hypothetical example. Then we'll go on to the next one. Now this one's very, very interesting. It might be like, kind of a light bulb situation. So a lot of people be like, how is that actually correct? We have the late investor. This person, which a lot of people, they wait in life to start investing for the future. And so this one is starting at 35, investing all the way to 65 for 30 years, $200 a month, 7% hypothetical return, but they only have $242,600 at the ending balance. So the previous example, early investor, only invested for 10 years. 10 years, when the other one invested for 30. But because that early investor started before the late investor and was able to have all of those years of compounding, extra years of compounding interest on their investments, they actually were able to outgrow the late investor that invested over a 30-year time frame. So just kind of shows the earlier you start, the better situation you may be in. And then we'll look at the final one. All right, this is the consistent saver. So not consistent investor, consistent saver. This is the person that invested from 25, 65, 40 years, but was very cautious and conservative and did not want to put their money in the stock market or in the bond market, or maybe just partially in the bond market, but really just kind of kept their money in the savings account. Only gained a 2.3% return over that time frame and ended with $158,000, in change. So, really now seeing them all here laid out, the bottom three are kind of close together, somewhat close together, but the drastically, higher outcome is the one that is the person that's consistent, and also the person that's willing to take some risk for their future. Obviously in a diversified way, in diversified asset allocation, but it's just compounding interest. It's very important to start early, to be consistent, and to know when to take risk. Because if your goal is for retirement 40 years away, that is time that you should consider taking it. But, work with your professional, of course, because based on your situation, maybe you shouldn't be taking that much risk. And so that's kind of what I have on compounding interest.
Eric, that was a great lesson. Just to add real quick too. I mean, just like Eric was saying with consistency, I also think of another term, which, you want to be disciplined, as Eric, I'm sure will agree. You got to be really disciplined and put money aside for that long term. Don't have those. We all like nice things, but we want to save for long term, and just being disciplined and consistent, like Eric was talking about. I mean, the screen kind of shares the outcomes.
So something that was mentioned a bunch of times specifically on this slide was investing with risk. So Stan, could you tell us more about that?
Yeah, let's talk a little bit about that, because risk is always the possibility. What's risk? Risk is the possibility that actual returns may be different than what you're actually expecting from your future returns of your investment. It could be you could actually lose money, obviously investing. There are inherent risks when you invest, whether it's stocks, whether it's bonds, even real estate for that matter, right? There's always risk involved. So let's talk about a couple here. There's unsystematic risk. You can see on the screen is really, it could be company specific, it could be industry specific. It can be avoided, minimizing through diversification, like we talked about earlier. And an example of this would be, let's talk about maybe a product recall, like you see on the screen, impacting one industry, or maybe another one could be regulations could change in a particular sector. Maybe it could be oil, there could be any type of energy or any technology company and things of that nature. We're dealing with AI and things right now. If something could change, that can change dramatically, and we have to diversify. That's a key reason for diversification. We don't want to have kind of concentrated risk. Systematic risk is the other one, where that really ties into the overall economy we're looking at. So those are things that cannot be avoided to the investor. And it's things like recession, inflationary changes, even interest rate moves right now, what we're experiencing. We have no control over this. And that's why, again, you want to really diversify, have appropriate investments, have a lot of different types of investments to protect yourself or help mitigate some of the risks through diversification.
Honestly, with that, I think we've covered almost all of the financial basics. We can't cover everything within one webinar just like this, but we can start to get you started, right? So now is a really great time to ask our financial advisors any questions you might have about the basics of getting your financial situation in order. So there's a box down below. Feel free to ask us any questions, and if we can't answer you today, we will reach out to you as soon as possible. And Stan and Eric, if you have anything specific that you'd like to add, now's the time.
I'd just like to thank everybody for coming today. I hope you picked up some ideas and things. We covered a couple, again, basics, but some particular areas as well. And thanks again for coming, and look forward to other ones we'll do for you as well.
Yeah, and I'll just say a lot of the stuff we went over today are, your general rules of thumb, your general guidelines. Everyone has their own unique situation, unique goals, unique path that they're on. So really, I do recommend that you, whether it be with, Stan, or whether it be myself or another financial professional, I do recommend you get assistance. They can give great advice on your specific situation, and not just some general rule of thumb that might work for some but not work for others. There's not one path that's perfect for everyone, so you just got to make sure you find the one that's right for you.
Exactly.
All right, so thank you to everyone for joining us going back to basics. As always, if you need to reach us, here's our contact information, and we'll get back to you as soon as we can. And we look forward to seeing you again soon.
Thank you.
Thanks, everybody. Take care.